people are afraid of AI specifically taking jobs away. And I have a theory that the jobs will stay the same. People will just work a whole lot less hours.
Welcome to Personal Finance Cat, where I share my personal take on personal finance. Hi, Ryan. Welcome to the show.
Thank you so much for having me. How exciting to be here.
Yeah, likewise. You had a very extensive experience in the investing world, and you also have a book. You're author of a 500 plus page book, if I recall that correctly.
Yes.
Tell us what inspired you to write that book.
Well, that's a question that I received from my editor a lot of times, and I would give vague answers like, I want to write a cool book, or I want to write a book that has never been written before. And he would ask me questions about who the audience is, and that just kind of developed over the 3-year period. I wanted to write a book that hasn't been written before. That was the most important thing to me. So, by the time I was in my mid-30s, I read well over 1,000 investment finance books, and they just were retreads. So many of the books were just repeating the ideas or the formulas that prior authors have written about. So I wanted to write something fresh with new ideas. And then, as I got into it, I tried to write it so a wide audience could enjoy it. But it's written in 4 sections. So certain types of people are going to enjoy different sections more than others, So the first part's real finance, investing heavy, and then it gets a little bit more generally interesting as it goes on.
Gotcha.
Yeah.
Is there sort of a key message or general theme that can be summarized from your book, or some maybe helpful topics that you think people can benefit from?
Oh, certainly. The title of the book's Time Ahead, Investor's Guide to Prosperity and Impact. And I really, it was important to me to have that word impact in the title because that's a very personal thing. But I believe that the biggest way we can make an impact through charitable giving is the way that Buffett's doing it or Bezos is doing it, where, you compound your savings or your capital at a high responsible rate, and that allows you down the road to give the most amount of money to charity. So the entire book is written about this thing we have called capitalism and how to compete and be successful in capitalism. That's really what the entire book is about. And then at the end of the book, I talk about the major trends that are happening in capitalism that I believe will continue to push the price to earnings multiple of the market up in the future.
Mm-hmm. Yeah. So what is your investing style? I think maybe the pictures in the background kind of give it away. But if you could summarize sort of your approach to investing as a financial advisor, what's the methodology on a high level that you utilize?
Well, and I'm a portfolio manager. So Buffett taught us that risk is the probability of losing money over a long period of time, right? So in our industry, risk is generally referred to as volatility, how much something fluctuates up and down. So somebody would always say, well, the textbooks would always say, well, this investment is more volatile than this investment, say a stock versus a bond. So a stock's always has higher risk. But Buffett taught us to ask a fundamental question. Well, what is the price? So there is a price where the probability of losing money owning a business is very low over a long run. And there's a price that a bond has losing to inflation over the long run. So he kind of taught us how to look at risk differently. So I apply that tenet, but I expand it just to not look at price, but to look at operating environment. So the example that I use with people, if you walk down a flight of stairs, versus if that flight of stairs is covered with snow and ice, the action is the same. You're still walking down the flight of stairs, but the risk that you're taking is substantially higher when you're walking down the stairs with ice on it. And investing is the same way. There's a lot of factors that we can measure and analyze to understand if this investment or operating environment has a substantially higher amount of risk today than normal, or the opposite. Is there an abundance of opportunity out there? And in that environment, we want to take a higher amount of risk than what kind of like our strategic or long-term target is. So that's the first tenet. The interesting thing about Buffett is he's called a value investor. And really what he is he's a growth at a reasonable price investor. And he is focused on how much capital or cash he can take out of a business over a long period of time. Now he's quite old, so the businesses that he's an expert in are now mature. So they're more value-oriented businesses. But recently he was asked, if he could do it all over again, what would he do? And he said he would be an expert in technology. So he has missed out on investing in technology, not because he doesn't want to invest in technology, it's because he doesn't understand technology. So I think that's where younger investors can still apply all of the lessons that he taught us over his career and apply those to higher growth businesses that have brighter futures, but still have all of those sustainable competitive advantages that he taught us about. But they might be in industries that have the winds of capitalism at their back, not a lot of these value type industries that have the winds of capitalism in their face. So part of the reason why I wrote the book was to do what he did. He passed on the knowledge from Benjamin Graham, and he passed it on to us. And probably the target audience I was writing to, it was my grandkids that aren't even born yet, because I wanted to write a timeless book that these behaviors and actions will continue to work in capitalism when, years and decades from now.
Yeah, that's awesome, because I hear all too often that people are criticizing that Warren Buffett's methodology is so outdated and he hasn't outperformed S&P 500 in the last, 10, 20 years or so. And the reason why I disagree, I think similar to you, is that he was kind of sticking in his circle of competence, right? Which is something that we talk a lot about. And, he's okay with doing that. And plus at this time of his career, I think he's in a different phase than most of the investors out there, right? So I think the tenets and principles that he talks a lot about are still super helpful for everybody, but people just can't see through or see past that. But anyway,
you're right.
Yeah,
you're exactly right. The mathematics essentially that he taught us, and the importance of owning businesses that have moats and sustainable competitive advantages, that's where you get analytical confidence from. Those will always be in place. Mm-hmm. And the other thing that people don't understand is he has a size disadvantage too. Mm-hmm. So where early in his career, when he was managing lower amounts of money, he could invest in smaller businesses and that would move the needle. Now he can only invest essentially in mega caps that will move the needle. So size actually, in portfolio management, there's diminishing benefit of getting larger.
Mm-hmm. Yeah, that was the first time I heard about. I think you referenced him saying if he were to do it again, he would study the technology sector. When did he say that? Was it in the recent?
Yeah, it was recently. I read so much. Remembering the sources are impossible. Mm-hmm. I just. Buffett says he reads 300 pages a day, and I don't know what my number is, but it's a lot.
Right.
But and it makes sense, right? You look at market capitalization, and he has. I think I did the math in the book, so this is a little dated, but technology's a $13 trillion industry, in the United States. No, excuse me, I got that wrong. Yeah, about that in the United States, depending on how you split it up, like if you count Google as a technology company or you count it as a communications company, if you count Tesla as a technology company or you count Tesla as a computer products company. So depending on how you slice it, Amazon's in the same category there. But, he has to pass on a lot of huge companies just because it's outside of, as you said, a circle of competence. So that's a regret that he has, and I try to not make that mistake. But hopefully, I'm doing this when I'm in my 90s, and these industries that are growth today will be value in the future, most likely.
Yep. So, what are you focused on right now? I think it sounds like the technology industry is something that, in your words, that have tailwinds from capitalism, right? That's really benefiting from kind of the current environment.
Right.
Is there any sort of specific area or companies that you are focused on and bullish on?
Well, I have to be careful with being registered,
Yeah.
because it can be construed as an investment idea. But if you think about companies that the marginal cost of production is zero, that's interesting. So most companies have to incur costs, substantial costs, to produce a high volume of products. And, for the first time in human history, with AI and computer technology, companies can just produce products at no cost. So you can add one more user and the cost is, close to zero. So those type of businesses that are very high margin, high growth, they have high switch costs associated with them. Those are interesting to me.
Yeah. No, that makes total sense. And I think maybe going back to a point you raised about the companies with competitive, durable advantage, right? A lot of these companies have that characteristic because they're essentially a monopoly, not the kind that violates the law, hopefully, but just because their products or services are so superior that naturally people want to use their product, and it made it an economic monopoly. And I recently read a book by Peter Thiel, Zero to One, and he talked about how, these companies generally will try to say they're not a monopoly, so opposite to what you would think. And then the companies that actually are in super competitive environment will say how their products are differentiated. So, I thought that was very interesting. But anyway, so
definitely, and there's a lot of industries that are smaller where they're dominated by single companies. So they might have that monopoly characteristic primarily because they were first to market, they had a first mover advantage, and then they made strategic acquisitions over the years that kind of fell under the radar, and they keep, as their industry expanded, they just were the sole source of a lot of information. So you see companies that have very unique and valuable data sets. There's like a sole source of information that if you want to be in that industry, you have to be their customer. So when you have that characteristic, those businesses have a lot of pricing power. So as costs rise, they can pass on those prices to their customers, in perpetuity, frankly.
One industry I want to maybe talk about, if you can sort of talk broadly, not about any particular company, is AI, obviously, because there's just so much development in this industry. It's unbelievable. And I've listened to many experts talk about it, right? There's sort of, I want to say, a lot of very credible and respected individuals that think this is going to be probably the biggest thing in our lifetime. It's so transformative that it's going to be like the second industrial revolution, especially if you combine it with robotics. But other people are very cautious about it because they think AI is going to take over the world, and there's a lot of potential dangers. I'm just wondering if you have studied this particular sector of the tech industry, and if so, what's your view on it?
Yeah, I wrote a book on AI, or a chapter on AI and a chapter on
Okay.
robotics. So, and you're right, the large language models and the interaction between humans and those models, connecting them with, uh, you know, a machine that's smarter than the smartest human by a log order. Um, that has big implications for a lot of industries. And I think we are on the cusp of it. I don't think this is in a lot of it. You don't know what's going on because companies are developing these in stealth mode. Uh, but when you look at all of the money that is being spent on AI, I think the world is going to look very different 10 years from now than it does today,
Mhm.
so, and I really think we're in the second inning maybe of this.
Mhm. So you were pretty optimistic about it. What do you think of the potential risks?
Well, so you say, look at the history of technology, right? So technology has generally afforded people more time and freedom.
Hmm.
So if AI gives us more time and more freedom, one idea that I bring to the front in the book is if you study the history of technology, the more tech that happens, people work less hours. So people are afraid of of AI specifically taking jobs away. And I have a theory that the jobs will stay the same. People will just work a whole lot less hours. So instead of, if you study, let's go back 1,000 years ago, or let's say let's go back before there was farming, right? So we would work 7 days a week, sun up to sundown, looking for food. Well, then we figured out how to farm. So then our days got maybe 6 days a week, got shorter. And then the Industrial Revolution came around, and people started working, a more structured time slot. And you might have two shifts that would come in. And then Gerald Ford came in and created the 40-hour work week. So, I think in the future we'll have there's already evidence that a 4-day work week has tremendous human benefits to it. Teams are actually more productive, they're happier, employees stay longer. There's good evidence of that. And I don't know why it would stop at 4 days a week. I could see 3 days a week, and then what does that do? That gives more time to families. And when families spend more time together, good things happen. So that's how I see AI, frankly. I see that as the most highest probable outcome. Um, who wants AI to get into the hands of bad actors that will use it for, evil purposes? I don't think anybody wants that. So when I kind of call this the greater force. When the whole world doesn't want things like terrorism, what is a huge risk comes down over time when we put our collective um, effort behind a common idea. And I think AI will fall into that category as well. I don't think anybody wants AI to get into bad actors' hands. And, this is we're already seeing early evidence of this, but it's going to dramatically change um, how nations protect themselves. So AI will allow countries to protect themselves at a higher rate than they ever have in history. So if you look at it from that perspective, the risk then goes down as well. So,
Mhm. Yeah, I think that makes sense. I think there's definitely going to be regulation, and that's a huge debate right now too,
sure.
is how much is the right amount.
Right.
But one other aspect I think potentially more concerning is we don't know what we don't know. And there is something called singularity. So when you develop the AI models to become more and more intelligent, at what point did it become a singularity where you can't go back because the AI sort of took on its own path? It's so much faster at learning, becomes this super intelligent thing that we lose control as a human species. I don't know if you have any thought on that, because for me, it's hard for me to understand, not being a technologist, but that's kind of a danger I hear people talk about. And it does sound potentially very alarming. What do you think?
Well, I think regulation is important.
Mm-hmm.
So, like Musk says, do you want to fly on an airplane that's not regulated by the FAA? It's like capitalism is a wonderful thing, and it helps to drive growth and find great pricing, find fair pricing. It does a lot of things very, very well. But capitalism also fails in certain areas, right? So, if you just apply the capitalistic model to the airline industry with the theory that, the airlines will just self-regulate themselves because if anybody has a plane crash, they just won't fly on that airline. Well, we might not have any airlines today if people took that approach. So there will need to be some form of regulation. The singularity risk is a real one. That nobody wants. So I think that would be, an area that companies would need to cooperate with government agencies and make sure that doesn't happen.
Yep. Well, fingers crossed. Let's all hope that there's a good way out. So I want to talk about maybe how you kind of manage your portfolio. I understand that you have a wide range of customers that you serve.
Yeah.
And you also mentioned that it's very important to educate them. So can you talk about that? What do you mean by that? And why do you think that's beneficial?
Well, you want to own businesses, right? So the first thing that you want to do is you want to own businesses. And then you say, well, what type of business do I want to own and how do I want to own it and how many businesses do I want to own? So those are fundamental questions that you need to understand beforehand. The more businesses that you own, you eventually start to act like indices. So then, I write this chapter called Resolving the Active Passive Debate, where I kind of take both sides and I put forth an argument from both sides, where I say, okay, well, these are the benefits of passive investing. These are the benefits of active investing. And what I do brings the positives of both of those strategies together. So in our portfolios, we're sector neutral. So there's very little evidence that sector bets work, so you can look at people that try to time the business cycle. There's been white papers written on this. That's a very, very difficult thing to do. And even if you do it perfectly, it adds a little over 1% of annual return. So we want to and David Swenson does a good job in his book, Pioneering Portfolio Management, where he kind of teaches you where to look for alpha. And that's where we focus our portfolio on. So you want to own businesses that do not require a lot of turnover to be profitable. So you want to own businesses that you can hold on to for a long period of time, and you can delay the tax recognition on those companies. You also want to do important things inside of the portfolio, like tax loss harvest. So this is an issue. The passive investing has two major issues. One is ethics. So if you care about the business that your company profits from, that's index funds are generally not for you, right? So if you're fine profiting off of things like tobacco and alcohol and weapons or abortion or marijuana or whatever those are, you have to not really own index funds, right? So that's a big thing that I think a lot of investors don't really think about. And in our portfolio, I do have ethical screens that are important to me. But that's a very personal activity. Everybody has their own definition of ethics. So if that's important to you, you have to kind of be selective on the companies you pick. Well, if that's the case, well, then how do you go about doing that? And then with indexing, you don't really have the ability to take advantage of this amazing net worth creator called tax loss harvesting. So the evidence of tax loss harvesting, and these are studies written by companies that are traditionally passive like Vanguard, is obvious. I mean, you can add, it doesn't show up, tax loss harvesting doesn't show up on a performance report. What it is it shows up into the capital flows into the portfolio. So if you manage a portfolio very well, it doesn't show up as your percentage return, but it shows up in the arithmetic of additions or withdrawals because of taxes. So if you have a portfolio that's tax loss harvested over time, the percentage return might be the same, but the actual size of the portfolio would be substantially different. That's kind of hard for people to understand. We actually show a slide that helps with that. But tax loss harvesting doesn't show up in that percentage. It just shows up in the net worth of the investor. And then, there's environments where the probability of a bear market is substantially higher than normal. And, we use a rule-based algorithm with about 190 factors in it that gives a bear market probability. And if that probability is rather high, we reduce risk around our target. So let's say our target's 60, we want to have 60% of our money in businesses. If the probability of a bear market is high, we'll be below that. And, like after COVID, for example, or in July of 17th of 2022, when the probability of a bear market was very low, we had more risk in the portfolio. So I think that's, when you combine all, and there's a lot of alpha there, right? So there's easy alpha with tax loss harvesting. There's a lot of alpha with owning businesses with sustainable competitive advantages. There's a lot of alpha in tactically allocating your portfolio based on bear market probability. So that's where our focus is.
That's very interesting. I have a couple of follow-up questions. So for the tax loss harvesting, when you say there are alphas that can potentially be tax loss harvesting opportunities, do you mean that when you purchased the stock of this company, it looked like it had potential, but then it didn't pan out, and therefore you sell it to harvest the loss? Or is that how it works? Or?
Yeah. So, as a portfolio manager, and, you get to make a lot of good and bad decisions. So after you're doing this for over 20 years, neither of those really fuss you. So if you make a bad decision and then you have to revisit the analysis that led you to have your investment thesis. And if that thesis is still intact, you want to add capital to that business. So let's say you buy a business, you're wrong or maybe early, and the value of that company goes down after you purchase it. Well, if that investment thesis is still valid and the company is now just 10 or 15% more attractive, normally you'd want to increase capital to that investment. Mm-hmm. But if you have a situation where you have a investment and it went poorly, and then you revisit that analysis and you were just wrong, and as Buffett says, you blew it, you have to exit that position right away. Mm-hmm. And that's where that portfolio manager hubris is very expensive for a lot of investors, where they just cannot have that egg on their face. And, it's hard for people just to admit that they made a big mistake and then just move on. Traders actually are better at this. So with tax loss harvesting, just to understand how it works, is the key is you have to find a highly correlated security. So if you would sell one security and then turn around and replace that security with a highly correlated security, meaning that it has a history of going in the same direction, they zig and zag together. Well, all you have to do is hold on to that position for 30 days, and then you could buy your original investment back. So let's use, in the book, I use AT&T and Verizon. If you look at their charts, they're joined at the hip. Or Coke and Pepsi would be another good example. If you look at a chart of those those companies, they're so highly correlated to each other. So let's say you invest in Verizon and you blew it and you lost money, and you say, you know what, I really want to invest in the telecom space and cell phone markets in the future. So what you can do is you can liquidate that, and then you could buy AT&T, hold on to AT&T for 30 days. Then after 30 days, you can buy your Verizon back. So if in that 30-day period, if there's a large increase in price, you don't lose out on that opportunity. But what you do is you get to lock in that tax loss. And that's how tax loss harvesting works. It's a lot of work when you manage portfolios, but we have amazing software today that makes it pretty easy.
Oh, wow. Okay. That's very educational. Thanks for walking through that example. But this whole time I was thinking about the example of Charlie Munger and Alibaba, because I think at some point he sold half of his holding in Alibaba, and people were guessing that it was for loss harvesting purposes before he admitted that it was the biggest mistake that he made.
Well, but if he would have bought it and then with that capital purchased a highly correlated security to Alibaba, if that massive price appreciation happens in that 30-day window, he can still enjoy that.
Mm-hmm.
But let's just say 30 days go by and nothing really happens with the stock, or it even goes lower. Well, then you can turn around and repurchase your Alibaba and lock in that loss.
I think you had a point about this helps with increasing your net worth, even though it doesn't show up as sort of a performance metric. Is that illustrated in the book when you say there was a slide that shows that?
I talk about it. I do try to illustrate it in the book. In the book, I have about over 90 charts and tables and graphs and quotes and analogies and things like that to really try to make it easy to understand. So yeah, I think it's one of those things. Once you read it and then you see it, it helps with the understanding.
Yeah.
If you add money to a portfolio, or you take money away from a portfolio, it doesn't impact your time weighted rate of return, right? So it doesn't have any influence. So as you save in your 401k, for example, as somebody dollar cost averages and saves in their 401k, it doesn't mean that they've had a percentage return, but the value of the account has continued to grow. And that's a similar way to think about how you see the benefits of tax loss harvesting. But instead of it being a deposit into the portfolio, it could be potentially a withdrawal, and that withdrawal goes out of the portfolio to go to pay taxes.
And it also sounds like that you have a pretty large portfolio that you're managing. And I think you sort of answered my question is how you're able to manage it. It sounds like you have some software that helps you do these formulaic actions.
You're exactly right. So as an investor, what you want to do is think about the maximum and minimum risk positions. So you would say, okay, what is the economic? So there's 4 areas. There's valuation, there's technical analysis. I call it market health. People don't know what technical is, but I refer to it as a healthy market versus an unhealthy market. Sentiment, and then economics, obviously. So if you would say, okay, well, what is maximum bearish conditions? Well, that's everything's expensive, so valuation is overvalued. The market is unhealthy, are technically, it's looking more like a bear market and behaving more like a bear market than it is a bull market. The economy is overheated and heading into a recession, and people are way too optimistic and greedy. Historically, when those four conditions exist, the probability of a bear market is extremely high. And the opposite's true. So if the market is technically sick, but starting to get healthy again and starting to act like early stages bull market, the economy is troughing and looking like it's moving from a trough to an expansionary phase. The valuation factors are very attractive. So you do Buffett math, and there's an abundance of investment opportunities, and you can just see that companies are really cheap. And that's not historically, that's based on future cash flows. You don't want to look in the rearview mirror and try to, I'll talk about that in a second. And then people are really afraid and sitting on a lot of cash and nervous. And we have 190 variables that capture this. So it's not like we guess at this or we speculate this, we calculate it, right? So you say, okay, if we're maximum bearish, maximum bullish, we know what that looks like, and we know what our risk parameters need to look like. And then on a weekly basis, we recalculate that analysis, and we adjust the amount of risk that we're taking in portfolios based on that analysis. Okay, so that's one way that you can manage a lot of money, is build algorithms that do all the calculating for you. So when things like COVID happen, you're not scrambling. You're just updating your historically proven analytics, and that algorithm is already being updated, like dynamically. So that's number one. And then number two is that you have to pay a lot of money to have really powerful portfolio management software. So when you have really good portfolio management software and you have algorithms doing all of these calculations for you, it really allows a portfolio manager to take advantage of seize opportunities and to identify risks, hopefully before they present themselves in asset prices, and reposition people's life savings more defensively. Okay, so that's how you can do it on a large scale.
Gotcha. So that's my other question, which is, are we at a point where you think the bear market is likely to come, if you're allowed to say it?
Yeah, so I could just tell you, valuation wise, let me just talk a little bit about valuation. So here's a fact. Younger portfolio managers outperform older portfolio managers. That's been proven. And it's just bothered me for so long. You know, I read this 15 years ago, and I read this whole white paper on it, and it's true, you know. And it's just, I thought about it more time than you could even imagine, you know, because I'm like, oh my gosh, I'm getting older as a portfolio manager. What's going on here? I don't want to fall into the, start underperforming. And I think the reason is if you chart the price to earnings multiple over time, what you find is a positive slope. Okay. So if you take the price to earnings multiple and you go back throughout history and you plot it on a chart and you create a trend line, well, that trend line has a positive slope. So what does that mean? It means businesses have always been more expensive than what they used to be. So I think a curse of experience, potentially, this is a theory, is that investors always say, well, I could have gotten these deals 20 years ago, or, I managed money all through the Great Recession. We could have got, much higher, better prices. So you see a lot of people make big assertions based on historical charts saying that stocks are expensive today because of the rearview mirror. In the rearview mirror, they were cheaper. But if you think about it, Wall Street's been saying that for 100 years, and for 100 years they've been wrong, right? Okay, so then I started thinking, I said, okay, well, if the slope is positive, what are the catalysts that will cause the price to earnings multiple to keep going up? And that's what the whole fourth part of the book is, where you say, okay, what are the industries that are going to keep pushing this price to earnings multiple up in the future? And then what are other things that potentially could push the price to earnings multiple up in the future? And one of those is this secular deflationary trend that we have, where technology makes things cheaper and shifting to lower cost labor providers really over time puts a lid on prices, as well as an aging population, right? So that's one thing. The discount rate could actually go down. That pushes the price to earnings multiple up. But I think a major factor in this positive slope is longevity and human beings living longer. So if you look at a chart of average life expectancy, it also has a positive slope. So then I started thinking, and I say, okay, well, if people just keep living longer, then the price to earnings multiple will continue to go up, right? And we talked about AI earlier. There's more money being spent on longevity than at any point in history. More money probably has been spent on longevity. It's hard to prove, but probably in 2024 that was spent, maybe the prior history of the science. So if we would have a situation where AI for the good starts to help people live longer, healthier lives, potentially substantially healthier lives in the future, then instead of us having an expectation of living into our 80s, maybe we have an expectations of living into our hundreds. And if we have an expectation of living into our hundreds, that may just change the amount of demand for equities over time. So if demand for equities is higher and there's a fixed amount of equities, that pushes up the price to earnings multiple. So I brought a geneticist in because I'm not an expert to help me with that chapter. It's about 45 pages. It's cool. I talk about blue zones and I talk about a lot of things that are going on in longevity science. And for me, that's my favorite chapter in the book because it was just so cool to write. And it really, you really are challenged to say, okay, as an investor, price to earnings multiple has a positive slope. Explain it. Why is it going to have a positive slope 15 to 20 years from now?
Yeah, wow, that's very interesting. I've never heard about anything remotely related to that, but I guess it makes sense when people get older, even though they are still alive and still need income, they might not be working. So they have this need to have a portfolio of investments to keep up with it. And then therefore that drives up the demand. Although I do feel like what's kind of going on currently with people's health, I heard that the life expectancy actually is going down. But probably to your point, I think it will go up because people are already realizing this. And, there are a lot of different things being done to reverse that. There's a guy, I think he's very famous on the internet now. He's trying to reverse aging and he's like everywhere. I definitely see that there is a push for making people healthier, and the documentary on the blue zone I think also makes people realize how important is diet, exercise, etc.
And now what we have is we have the ability to measure somebody's biological age, not just their calendar age.
Mm-hmm.
So there's DNA methylation is a way for us to measure how old we are biologically. So that's where that's coming from. And I think you might be referring to Brian Johnson,
Yes.
who spends $2 million a year. And the guy looks phenomenal for, first of all, he's my age, looks like 30 years younger than me. And he's going over the top. And, we need people like him because he pushes, he's using himself as a human guinea pig. It's amazing, but there is scientific evidence, specifically coming out of Harvard, where Dr. Sinclair out of Harvard is showing that you can age and de-age cells. So you can actually increase aging and decrease aging. University of San Diego had a big study on this too.
Oh, wow.
So that's what I'm saying. We used to have to wait 20 years to get longevity experiment results. So we'd have one experiment, it might take us 20 years. Well, now with the use of AI and measuring how old an organism is getting in real time, we can do 10,000 a year, where we used to be able to do one. So that's where maybe the optimist in me says there could be really something there, because we do have evidence of other species that live a very long time, right? And if you're a believer in the Bible, supposedly early in human history, people lived hundreds of years, 700 years, right? So I'm not saying I believe that or not, but a lot of people do believe that. And some people believe that that's true, first of all, that there must have been something that happened genetically to us to make us live a lot shorter life. So in that longevity community, they're looking at down-regulating certain genes potentially to increase life expectancy. And again, I'm not an expert on this. I brought an expert in. I brought a PhD in genetics to help write the chapter and basically make sure that everything that I wrote there was within current scientific thinking. So that expectation could change, and it's just not living older, it's living healthier. So if you look at what AI has done in Alzheimer's, for example, right? So, machine learning showed AI brain images, and then it showed brain images of patients with Alzheimer's, and AI is able to detect early on stage Alzheimer's at a much more accurate rate than humans can. And with these Alzheimer medications, they need to be started early. By the time people go to a doctor and say, hey, I can't remember anything, I have Alzheimer's, a lot of times for the current medication, it's too late. And if you catch it early, like a lot of things, right? Like, most viruses or anything, if you catch them earlier, like Tamiflu, for example, works very well if you catch it within the first 24 hours or 48 hours. But if you wait till you're already extremely sick, you're too late. So I think that's what we're going to see in medicine, and we're going to see AI allow scientists to do experiments at a much, much faster rate and get real-time results at a much faster rate, and then be able to use AI to forecast where there might be failures in some of these clinical trials. So that's another interesting thing that's happening, is that there's venture capital money being put behind these companies that do AI-assisted clinical trials, where you could say, well, this drug might have an issue with this subset of the population. So instead of going through all these trials, they'll just go directly to that subset of the population and do a more focused clinical trial. What that means is drugs will come to the market faster and cheaper. So it
Mhm.
has, there's a lot of things that, in the healthcare and science industry that AI um, is really assisting the development and also the speed, the time that it takes for this to happen.
I'm also very optimistic about AI and what it can bring about. My point of view on the PE going higher and higher is that I feel like a lot of the technology companies, I know it's cliche to say that, but they're just going to create new categories. Your price to earnings ratio is based on past earnings, but you're looking at the future of the company. And if it's going to create an entire category of its own and it's growing tremendously, like how do you put a value on that? I feel like PE is a very restrictive ratio to look at. And I think that's why a lot of these technology companies have high PE ratio. I think we're going to get a lot of them wrong, but there will be winners that even at the current price, it's undervalued because there are so much future potential. I'm thinking about Tesla in my mind, for example. They're working on humanoids and other things that are not even like their main business right now that's actually generating cash. But if that happens, it's going to be potentially trillions of dollars. So even at the current price, you can arguably say that it's even undervalued. So I think that's another reason perhaps that can explain why the PE ratios are going higher. But anyway, so I don't think you
I agree. Yeah.
really
Okay.
answered the bear market question, but I'll take that because I think,
Gotta be careful with robotics. Right now I have a family of 5. We have 2 robots, right? They're called Roombas. All right. We used to vacuum the floor. Now
right.
Roomba we call her Ruby. Ruby takes care of the floor for us, and I think that's just going to become more normal in the future. I think, in the book, I have this, vision that I try to paint for readers of, you come home from work and as you're driving as you're sitting in your autonomous car, that's essentially a AI driven robot, right? You're sitting in your autonomous car, you drive by and you see robots walking dogs and you see robots flipping hamburgers and washing cars and mowing lawns. You already have that today with mowing lawns. And I just think that is going to, the idea of having like a humanoid robot in your house, I think seems a little weird for people, frankly. But I don't know. Did you see the Boston Scientific, the dog robot that takes everybody on the tour? I mean, it's just awesome. I think it's just going to become more and more normal, and we're going to blink. And like Musk says, and having a 2-to-1 robot to human ratio seems reasonable at some point in the future. Right now we're 2-to-5 in my house. But I could say, well, in the future we'll be 10-to-5. So if you're 10-to-5 in the future, well, and you say, there's going to be 10 billion people in the world, to think that there's going to be 20 billion robots in the world, I think there's a high probability of that happening.
Yeah.
So then you say, okay, as an investor, what does that mean? And most people would say, well, how do I get rich on robotics? But great investors think of it a different way. They say, okay, well, what industries are going to be disadvantaged by that trend? So that's what you have to understand as an investor. It's not actually profiting from the trend. It's making sure that you don't own a business that's going to be fundamentally disadvantaged, have the winds of capitalism in your face, and they're value traps where they look cheap, but they're in struggling operating environment because there's a technology that's taking share away. So, my mentor had a saying, it's more important to understand what not to own than to understand what to own. So that's really where the thinking should be for portfolio managers. We should be thinking like, okay, well, what industries are going to really be disadvantaged by this? A great example is what Amazon did to brick and mortar.
Yeah.
So, as an investor, the portfolio benefit of avoiding brick and mortar investments you can make an argument that avoiding the brick and mortar investments is more important for performance than actually owning the companies that take the share away. So it is a important activity that Charlie taught us. We always talk about Warren, but Charlie taught us about thinking. Warren taught us about reading and calculating, but Charlie really taught us about how to think. And as a portfolio manager, you really have to be disciplined and schedule time to think about how the winds of capitalism are going to impact businesses negatively, just not the positive. And everybody's really focused more. I think it's much more fun to talk about the booming industries than to talk about the industries that are, having negative revenue growth because they can, and then they're laying people off. And
yeah.
So Amazon's a great example of what they did, and we'll have more of those in our careers.
Yeah, for sure. I have a lot more questions, but I think we're kind of running short of time. So maybe I have one more interesting question and then sort of a standard question. It sounds like maybe you have some important deviations from Warren Buffett and Charlie Munger. One thing is, I think it comes through very clearly, is that you do look at macro trends, which is something I think Warren Buffett has said many times, that he's not a macro person. He looks at the micro level, like the individual company, and you look at these factors that try to see where the market is. Are there any other deviations that are key? For example, what's your view on cryptocurrency, Bitcoin specifically? Anything
Sure.
else?
So let me talk about that. So, Stanley D has a saying, he's bottom up macro, so I think it's a good way to look at it. How do you value a market? You value a market one business at a time, looking out the windshield. People always try to look in the rearview mirror and say the market's this because of the price to earnings ratio, but you actually have to value a market based on forward future cash flow and then discount that free cash flow to today. And how do you do that? You do that one business at a time. So you start bottom, and that brings you up to the macro. And in technical analysis, you don't want to use technical analysis, in my opinion, for micro. I don't think there's any value in trying to look at the technicals of an individual business. I don't think that provides a lot of value for investors. It's been proven. But if you look at big data and you apply those same technical principles to larger groups of data, it actually provides value for portfolio managers. And what it does is it allows you to not exit positions too early and not enter positions too early. So if you have analytics in your decision framework like momentum, where momentum analytics during the Great Recession was very valuable because companies got extremely cheap. So fundamentally you would say, well, I want to, buy aggressively. But what happened is those businesses then went down 20, 30, 40, 50% more. And that's why you have those momentum or technical factors in there as well. You have to have those. It allows you to hang on too, because sometimes the fundamentals take a little bit to catch up, right? To your point, right? And we know like a price to earnings ratio in a recession always looks higher than normal because E is suppressed, and in a bull market it looks fraudulently cheap because E is higher than normal, right? Cryptocurrency, that's what you want me to talk about. The CFA Institute, they did an amazing paper on cryptocurrency. I would encourage people to read it. It's about, I think, 70 pages, and it really takes a deep dive into valuing cryptocurrency. Cryptocurrency doesn't produce cash flow. So if you have an investment that doesn't produce cash flow, how do you value it? And so that you're speculating, right? So when an investment produces cash flow, you can actually make calculations based on that cash flow. And you could even apply this on the bottom side to commodities, that a commodity doesn't produce cash flow either, but there's companies in the industry that you could calculate kind of marginal production cost to figure out what a bottom level is for a commodity. At some point, a commodity goes down so much in price that mines start to shut down because it's no longer profitable. So for commodity valuation, you could figure out what the troughs are, but the peaks of the commodity, it's impossible to calculate. You really get away from high confidence analytical calculations to speculation, and I think cryptocurrencies fall into that category. And because of it, I don't own personally cryptocurrency, and I only own what clients own. So I'm really disciplined with that Buffett tenet. 98% of his portfolio was in his net worth was in his portfolio, and I use a similar philosophy.
Yeah.
So.
Gotcha. Great. All right. So my final question is, you've read so many books, over 1,000, I think you were saying. Are there a few of them that really stand out that you think everybody should read, especially people who are interested in investing?
Yes. Pioneering Portfolio Management by David Swensen is a phenomenal book. Mm-hmm. The first 50 pages are brutal, but if you can get through the first 50 pages, it really teaches investors about portfolio management principles. So Dr. Swensen, he passed away, unfortunately, but he managed the Yale endowment for decades, and his performance speaks for itself. He completely was the pioneer of how a lot of endowments and large pools of money are managed. So that's a great book to read. But again, it's heavy lifting the first 50. But once you get through that, my book's similar actually, and my editor recommended I write it that way. So it's kind of heavy lifting, and then it gets a lot more fun. Fooled by Randomness by Nassim Taleb is a fantastic book. I just really enjoyed reading that book. That's an important book for portfolio managers. You need to be able to understand if performance was skill-based or luck-based. And that's the idea of the entire book, where he talks about, being fooled by the randomness, meaning that there's so many investors throughout history where a portfolio manager would have a couple good years that just ended up, so people would say, well, that person, he or she has a major skill. And then they would put a bunch of money with that portfolio manager, and then they would lose a lot of money. And it was just that it wasn't skill that created the profits. It was just the randomness of the investment world. And that has a lot of wisdom. His writing style puts some people off. He's very direct, which I don't have any issue with. And then obviously, the intelligent investor, that's one where when they say, I want to become an investor, I give them that. And then they generally don't bring it back because they realize it's hard, and then when they bring it back, then I think the next best thing to hand them is all of the Buffett papers. Yep. So if you really want to learn how to do this, on my desk at my former firm, I had all of the Buffett papers printed off, and that's just packed with knowledge. And I've had this presentation that I've been showing people for years it's called Building Your Own Berkshire. And in the book, I call it Lessons from Warren Buffett. And there's just so much knowledge about how to think as a business owner there, and all of the mistakes and how honest he was with all of his mistakes. You can learn so much from them. So I think those are the four places to really focus in on if you want to be an investor. And the reality is that, a lot of people will say, well, what kind of degree should I get? You need to understand the language of business. So you have to really understand accounting. And that's not very fun. I get it. But, early in my career, I did financial statement creation and analysis, and really understanding the bottom up investing is a important place to start. A lot of people, they say, I want to become a great investor, but they have no foundation. You really have to put the time in to build that foundation and get through those accounting classes and things like that. I write this section called Apples to Apples, and where I compare, and this is going to make nobody want to read my book, but it's really kind of cool, where I basically say, well, this is why the price to earnings ratio is higher, and this is why you really shouldn't put too much weight in your decision framework over what businesses were valued at in the 1950s, or so you see some of these studies, they go back 150 years. It's like, that is irrelevant. And I make a case there that there's been so many changes that have happened that making an apples to apples comparison, where you're trying to look at a business in 2024 and compare that to 2084, it's not even a fair comparison. You're really just, saying, well, the market's overvalued today or the market's undervalued today because of this period in history. I think you need to really understand the accounting of investing. So that would be the other boring recommendation that I think people would really massively benefit from.
Yeah, that's awesome. So, but taking accounting classes is one thing. What about like the actual hands-on experience? Because I feel like theory is something, and then actual experience is completely another. What's your recommendation for people to actually gain some experience? Is it through reading the 10Ks, financial statements of actual companies, especially if they don't have training in accounting or business in college, let's say?
Well, with our young professionals, we have this growth trajectory for them. So I work at a very young firm, and we really invest a lot of time, energy, and money into our young professionals, and they're the lifeblood of our company. And on our team, we talk about knowledge, practice, execution, teaching, right? So you have to get the knowledge, but then you have to practice. So whatever you want to be great at, you have to put in reps. So if you want to be a amazing financial planner, you have to do a tremendous amount of financial planning, and then you progress in your career to teaching people, or explaining the financial planning, and then you teach the financial planning, and then that's when you can call yourself an expert, when you could start teaching others. So if you want to, depending on where somebody is at in their investment lifeline, if you have the knowledge, let's say you're phase 2, you have to just go and do it. You have to get out the 10Ks, you have to get out the annual reports, and you have to start creating forecasts, and you have to find something that you're truly an expert in. And the nice thing now is that you can find out what the experts' opinions are, because price targets are, really public information today. Mm-hmm. So if you wanted to become an expert on the utility sector, it's a really good place to start for somebody. But let's say you wanted to become an expert on utilities, because that's not that complicated. and you spent a tremendous amount of time researching utilities, analyzing utilities, understanding the economics behind a utility company, and then started to do those cash flow forecasts of a utility company, and then come up with a price that you would say, okay, well, I would pay this price all day for a utility company, and then double check your work with the other experts at these major firms that produce research. I think that's a requirement. You just, you cannot become a great 3-point shooter without shooting 100,000 3-pointers. And investing's no different. There's no shortcuts.
That's great. All right. Thank you so much, Ryan. This has been awesome. Thank you so much for your time. I really learned a lot and I really enjoyed our conversation.
Yeah, hope to be able to do it again. Thank you so much. It's nice to meet you.